So if you bought a house with less than 20% down on a conventional loan, you have what's called PMI, private mortgage insurance. And the good news is there's a way to remove your PMI without refinancing and losing your low rate. But this is only on conventional mortgages. Now first, what is PMI? You heard us talked about a lot. People don't really understand it and it kind of gets a bad rap. PMI is insurance that you pay for that's here to protect the lender. It used to be everyone had to put 20% down because if a lender had to foreclose on your property, after they paid legal costs and realtor fees and fixed the house up, they'd normally recover about 80% of the value. So the 20% down payment was required to make sure they didn't lose any money. Well, the PMI companies came along and said, hey, Mr. Lender, we're going to go ahead and insure you. So if someone puts less than 20% down, like say 10%, 5%, we'll do insurance that the borrower is going to pay for that protect you. So if you have to foreclose, we're going to cover the difference of those losses to make sure you come out whole. So I definitely hear negative things about PMI, but if without it, everyone would have to save up 20% down, and that's a lot when you're buying your first home. Now let's talk about 3 ways you can get rid of your PMI without refinancing. First, once your loan balance gets down to 78% of the original value of the house that you bought, the PMI automatically is removed. You don't have to contact anyone, you don't have to call anyone, it just drops off, and this is in the loan documentation that you sign at closing. Now the second option you actually put some work into, but it's not too bad. Once you get to 80% of the original value, you can just call your lender and ask them to remove the PMI. Now you wouldn't have to wait that much longer to get to 78%, but hey, every dollar counts, especially in this environment. Now the third option is probably going to be the fastest, depending on how much you put down originally. And this is after 2 years, you can request a lender to order a new appraisal. If the new value is high enough to where your current balance is 80% of the value, then they're going to remove that PMI. So for example, let's say you bought a house for $450,000 and after 2 years you owe $400,000 on it. If the appraisal comes back at $500,000, the amount that you owe is 80% of the new appraised value, and that's going to remove the PMI. Now, not a lot of lenders are going to tell you this information because it actually costs them money to remove that PMI, but it's definitely something that you want to do to save money and so you don't lose your current rate. And I hope this information helps. If you have any questions on it, let me know, and definitely subscribe to my channel to learn more things like this.